Section 4, Form of Chart. In this particular chapter, Wyckoff teaches us how to draw charts, construct charts. Then he also tells what all are the charts which we need to keep. We know there is a lot of charting methods, but which is the very essence to keep is what Wyckoff concentrate, and he exactly tells what is the purpose which we will be looking at all the charts. The very importance of keeping the charts is charts are the graphical representation of the action which is taking place. If we see a movie or if we see a person going on for a fight, we exactly know at what situation he is there and with what weapons he is carrying and what is the line of action as a picture that is depicted with the help of chart. We exactly know what is the operator's intention. The charts don't lie. Charts has all the transaction very faithfully recorded. So what all are the charts which are present? So Wyckoff advises us, or he has this charts which he uses for his purpose. The first is vertical line chart. So in this vertical line chart, we have the range that's like high, low, and then close. Sometimes open also, but open doesn't play a crucial role. High, low, and close plays a very crucial role as per Wyckoff. Then comes the figure chart. In figure charts, it's the horizontal formation which tells us how much distance they travel. Like it tells us the probable move of the market. It tells us how much can be the target which we can keep, and that's the very reason this particular type of chart is recommended. That's like figure chart, and figure chart was something, a virginal concept which was used by Wyckoff. Post Wyckoff, many CMT courses all are using the same figure charts importance, which was advised by Wyckoff. Then comes the third chart. The third chart, Wyckoff claims that he has completely developed on his own. That is Wyckoff wave. He calls it wave charts, and he recommends us to look at all the market operations in waves. So that gives us a very good perspective of markets. So waves tells us where can be the probable swings in the market, where we can take the turns. So with the help of wave chart, it reduces a lot of our time. So let's see what is recorded in chart, what are the detections or what are the details which we can get from chart and what it indicates. First, let's see in the vertical charts. So as we saw, the vertical charts indicates the trend, then it indicates where to buy, where to sell, and where to close out or book profit, and it tells where to place our stop loss order once we enter into the trade. And what all are the details which are recorded? The details which are recorded are price movement, volume, time, and closing price. These four are very important. That is again price movement, volume, time, and closing price. So what does price movement tell? Price movement tells the supply and demand. With just looking at the price, we know what is the supply and demand playing out, how it is playing out. And it tells points of resistance and support, and then it tells marking up and marking down progress. Then it tells lines of supply and support, and changes of stride and progress of movement, and also it tells comparative strength and weakness, which stock is stronger, where the operator is buying, which is very weaker, where the operators are booking out profit. This is done using price movement. Then comes the volume. In volume, we see the intensity of trading. That's like how many participants are interested. Then it tells the increasing or diminishing pressure of supply or demand. If supply is more and price is falling down, with the help of volume we can gauge, is the trend continuing, is the trend going in progress. If the price is going up and volume is not supporting it, we can gauge that the demand is reducing. So volume plays a very crucial role. Then comes time. Time tells speed of advances and declines, like in which rate it is going, what is the momentum, it is a climatic action or it is a normal action, it is slowly going, everything has a significance. So that is what time we need to gauge. So it also tells the duration of accumulation or distribution. Generally the rule of thumb is the bigger the accumulation, the more distance it will travel, or the more distribution, the more fall it can go. So that is the general interpretation of time. Then comes the closing price. Every single bar represents the pulling power between bears and the bulls, buyers and sellers, who is taking the price up, down. But the closing price exactly tells who won the game, which side the bias is in. And then we see the next chart. The next chart is figure chart. With the help of figure chart, we see the best opportunities. The probable distance a stock or a group of market should move. This tells how long the accumulation is, what kind of accumulation it is. So basically in this figure chart, we look at three things. We look at price movement, we look at general formation, we look at horizontal formation. So in price movement, again we look at supply and demand, and then we look at points of resistance and support, and then we look at marking up and marking down process. Then in general formation, we look at accumulation and distribution, and we see both the support and supply points, and we see the marking up and marking down progress. Then comes the third, the horizontal formation. The horizontal formation is the major thing. In a gun, when there are bullets loaded, how much bullets are loaded? So that's exactly is what this horizontal formation tells. How much interest is being accumulated in that stock. And then comes the final chart. The final chart is wave chart. Wave chart helps us the behavior of market at crucial points. The minor trend, the intermediate trend and the major trend, and how are the swings played out in this particular trends. So then we will see the turning points and responsiveness of the stock with the help of this wave charts. So this wave charts measures price movements, volume of trading, activity or intensity of trading, time or duration, then price changes from wave to wave. So here when it comes to price movements, we as usual gauge the supply and demand, the pulling power, the caliber, how a particular wave is, what is the speed of the wave, how healthy that wave is with respect to the time and the wave's duration, the extent which the wave has traveled. Then with the help of volume, particular complete swing, what was the volume? And then we will see the next swing. It was an impulsive swing, what was the volume? It was a corrective swing, what was the volume? Where was the interest more? This gives us better picture of the pulling power and people who are interested in the up move and down move. Then comes the activity or intensity of trading. How the move was? Was it very sharp? Was it spiking up and down, or was it normal? So we look at that. Then comes the time and duration. Was the wave smaller? Was the waves bigger? We look at those things. Then comes the price changes from wave to wave. First wave is traveling 10 points. The next wave, if it is traveling 5 points, 10 point is more than 5 point. But again, we need to compare it with the next wave, which can be 15 point, 4 point, 3 point. So this tells which is stronger. These waves are stronger, or how this particular waves are playing out. Is the wave increasing or decreasing? Those kind of cues we can get from this wave chart. So just to tell, these three charts are required. That is like vertical line charts. Then we look at a figure chart. Figure charts are also called point and figure charts. Then we look at wave chart.